Let's talk about the required disclosures for financing liabilities. Disclosures for short-term debt that's expected to be refinanced include a description of the agreement in terms of the new obligation incurred or expected to be incurred, or any equity issued or expected to be issued. Firms disclose the conditions and circumstances that avoid calling debt in a footnote. Disclosures for long-term debt include total amount of maturities and any sinking fund requirements for each of the next 5 years. A sinking fund, I don't know if you remember this one, is cash or other assets held in a separate account that is used to repay debt at maturity. Think about a bonds payable $25 million. You don't want to just all of a sudden say, oh, it's due. You want to be putting money aside. So you have a sinking fund set up so that you're ready to pay back debt at maturity. These disclosures provide financial statement users with the expected future cash payments based on current debt commitments. The disclosures also include a description of the rights and privileges of various classes of outstanding debt securities and any guarantees. Let's take a look at Johnson & Johnson long-term debt disclosures. Notice they have the total amount of debt in 2017 for each of those 5 years, and then the lump sum that's amount after 2021. Convertible debt has its own disclosures as well. Disclosures for debt with conversion and other options include information about the terms of the conversion and the manner in which convertible securities affect the financial statements. Separate disclosures are required for debt and equity components of hybrid securities that are separated on the balance sheet. And for the liability component, the entity must disclose the principal amount, the unamortized premium or discount, the net carrying amount of the debt, and the number of shares to be delivered upon conversion, the effective interest rate, the cash interest, the interest adjustment from the premium or discount amortization. Wow, quite a bit there. Fair value disclosures. If we have the fair value election going on, then we have to mark to market for those financing liabilities. Well, we need to disclose how we arrived at the fair value. So we have to disclose the valuation methods used and any assumptions made to arrive at that fair value.